But again, inflation is not just a domestic story. It's also part of the global growth story. Another news headline that crossed this morning, the International Monetary Fund painting a grim picture for 2022 as it again slashes its forecast, now projecting 3.2% growth this year. That's a noticeable downgrade from its previous projections. And the big reason, global inflation. The IMF expecting that prices this year will rise 6.6% in advanced economies and 9.5% in emerging market and developing economies. Here with more on that report is the IMF chief economist, Pierre-Olivier Gourinchas, joining us live on the program. Great to have you on the program. Just walk us through a little bit more exactly what the weight is of global inflation on the forecast, a noticeable downgrade from the last round of forecasts in April. How worried are you about global inflation tipping us into a global recession, perhaps?
Well, good morning. And you're right. I mean, pushing inflation has been one of the three factors we've highlighted behind the downward revision in our projections update. And the way inflation plays out here is that it's eroding purchasing power for consumers and households. And so that's leading to less demand. But it's also affecting their views on the outlook. It's creating uncertainty. It can increase their sense that maybe the future is less certain, is less secure. And it leads central banks, as we've seen the Fed doing in central banks around the world, really pretty much in every country maybe except China and Japan, to tighten monetary policy. And that tightening of monetary policy is also going to slow down economic activity. So that's one of the three main drivers of our revision.
So let's break down some of what we're seeing, where we're seeing that inflation come through from. Obviously, energy, a big one that we've been watching very closely. When you look at a place like Europe, there's still a lot of questions clouding the outlook there about what that supply is going to look like, both on oil as well as natural gas. How do you assess how significant a headwind that's likely to be as we look into next year?
Well, in the European context, this is where the second factor is playing out, and this is the impact, the continued impact of the Russian invasion of Ukraine and the impact it has on energy markets. And so we're revising down also our growth projections for the euro area, especially in 2023. In fact, in 2023, we are projecting that growth will slow down to about 1.2% for the euro area. But we're also flagging that there are important risks to the downside related to the supply of gas from Russia to the euro area. And if we were in a scenario where those Russian gas flows to Europe are fully shut down, then there would be another layer, if you want, in terms of the downward revision. And we're anticipating that it would knock off another roughly 0.8 percentage point of economic activity in the area. So this is sort of the second major factor that leads us to revise our projection is the slowdown we see in the euro area related to the impact of the war.
Well, as a follow-up, I want to ask about the central bank policies around all of these headwinds. When we talk about, for example, the European Central Bank hiking rates last week, the Federal Reserve having an important meeting tomorrow where they're also expected to raise interest rates, that's all supposed to get prices down. But as you just outlined, a lot of the price increases are due to something that's completely out of the central bank control, which is what's happening over in Eastern Europe. So do you worry about a central bank policy mistake here and hard landings, not just in the United States, but in other parts of the world as well?
Well, look, there are different sources behind the inflation numbers that we're seeing right now. And certainly, there are things related to energy and high oil prices and gas prices, for instance. But there are also, and supply chain disruptions, there are also demand factors. The fact that a lot of households came out from the pandemic with excess savings, what we call excess savings. They may not be seen as excess savings from the perspective of these households. So we have a combination of factors. But let's step back and think about where we were in terms of monetary policy back at the end of 2021. Conditions were extremely accommodating because central banks were trying to support their economies during the pandemic. And so it's only natural that at the very least we remove that level of support when we're moving away from the pandemic. And at the same time, we're facing these extremely high levels of inflation. So central banks have to tighten. They don't really have a choice at this point, regardless of where inflation is coming from. And we actually look at what a number of them are doing, and we think that this is more or less appropriate given the environment.
So they don't really have a choice here. Now, does that mean that emerging market central banks also don't have a choice here? We're seeing a strong dollar weighing around the world. I mean, this is raising perhaps some chatter of, could we see a 1994 like Mexican peso crisis? Could we see a 1997 like Asian financial crisis again, as some of these countries maybe have difficulty dealing with a devaluing currency domestically? Do you see that as an issue as well?
We certainly see a lot of financial tightening around the world, and it is having a serious effect on emerging markets. We see, as you mentioned, we see the strength of the US dollar. That's actually implying more inflation in a number of countries because they import goods that are invoiced in dollars, and so they see higher prices for these goods. It makes it harder to service dollar debt. We're seeing capital flow out of these countries, emerging market economies in particular, and we're seeing spreads increase. So all of this is adding to the pressure. At the same time, we are not seeing disorderly market conditions right now in the EM space. What we are seeing is a number of countries that have actually improved their policy framework, the way they conduct their monetary policy, the way they manage their exchange rate, let it adjust when conditions change, as we've seen, the way they try to use their instruments that they have at their disposal to protect their financial sector, to prevent banking meltdown and the financial sector panic. And so far, we haven't seen really any disorderly response in financial markets. So I want to say, yes, there is tightening. Yes, there is pressure. But as of now, we are not seeing anything like the taper tantrum of 2013 or the Asian financial crisis or even the Mexican crisis of 94, 95.
Let's talk specifically about China. You're projecting growth of 3.3%. That is well off the 5.5% that the government had set for itself this year. Obviously, the zero COVID policy playing into some of that as well. But I wonder, when you look at some of the headwinds, the risk factors in China, what concerns you the most? And we've been also watching what's been playing out in the property markets really closely. It sort of feels like the government is reversing its policy to really double down on some of that debt they were trying to slim back on because of where the economy is right now.
Yes, there's been that's the third sort of factor leading to our downward revision is China. And, when you put it all together, the U.S., the euro area and China, the three largest economies in the world, being revised down. This is what leads us to our gloomy outlook, if you want. But on China specifically, we are projecting 3.1% growth in 2022. And just as a point of reference, this is the lowest growth number since 1976 in China outside of the pandemic. So this is really something that is big news. And it's on the back of, as you pointed out, the COVID-19 outbreaks and lockdowns that we've seen in the first and second quarter, and also the slowdown in terms of the real estate sector. So looking forward, the good news about China is that it has a lot of policy space and it's not facing very strong inflation pressures. So it can remain more accommodating in terms of its policy stance. And in particular, fiscal policy can play a role to try to support the economy, and in particular, vulnerable households that might be suffering in the current environment. So we're seeing that there's room for China's sort of rebound in the second half of the year and in 2023.
And if we shift over to the United States, I mean, they had a pretty swift downgrade in this report compared to the April projections. Does that imply that you see a higher risk of a hard landing here in the United States?
Well, the way we would characterize it is that under our baseline projections, there is a narrower path. The growth is, as you show on your screen, is projected at 2.3% in 2022. Then we're expecting a slowdown on the back of this tightening of monetary policy and also in the context of still elevated inflation to about 1%. But the Q4 on Q4 growth in 2023 for the U.S. is estimated at about 0.6% in our projections. And 0.6% is a low number. It wouldn't take much of a downside, a materialization of a downside risk to sort of knock off the U.S. from having positive growth. So we're seeing a very narrow path going forward, not necessarily a recession under the baseline, but certainly a very vulnerable situation.
Certainly a lot of layers to all of this. IMF Chief Economist Pierre-Olivier Gourinchas, it's good to have your time today. Appreciate you stopping by. Well, let's take a look at one trending ticker we have been following today.